Every financial bubble in history started with the exact same phrase. This time is different. People said it before the dot-com crash, before the 2008 housing collapse, and right now, millions are saying it again, while the crowd celebrates new all-time highs in the S&P 500, while Bitcoin promises a new financial system, and the world becomes obsessed with artificial intelligence. Cracks are beginning to form beneath the surface. Because the most dangerous crises don't look like panic at first. They look like euphoria, right before the collapse. And today, we're going to answer one question. Are we witnessing the birth of a new economic era, or living inside the biggest financial bubble of our generation? If you enjoy content like this, drop a like, subscribe, and turn on notifications so you never miss an upload. So, the S&P 500 just hit a brand new all-time high, closing out at 7,230 points. The Nasdaq wasn't far behind, setting new records too, with a solid almost 1% gain on Friday. And get this, April actually turned out to be their best month since way back in 2020. Naturally, all the buzz in the headlines is about this AI euphoria, and how well the big tech companies are doing with their earnings. But if you take a step back for a moment, doesn't this whole rally just feel a bit more like concentrated hype, rather than a sign of genuine economic strength? There's something else happening that isn't really getting a lot of attention. This market move has actually been surprisingly narrow. You see, it's mostly a handful of these massive tech giants, fueled by exciting AI investment stories, that are doing all the heavy lifting. The rest of the market, well, it's not exactly joining in on the celebration. And you know what? We've certainly seen this sort of thing play out before. Just cast your mind back to the railroad boom in the 19th century. People truly believed that railroads were going to completely transform the world. Money poured in, companies expanded like crazy, and valuations just soared, mostly running on pure expectation. But then, reality eventually caught up. We saw overcapacity, a pile of debt, and a whole series of collapses, like the Panic of 1873. Sounds a little familiar, doesn't it? Or let's talk about the late 90s, that whole dot-com era. It was the same basic idea. The internet is going to change absolutely everything. You had companies with zero profits, crazy revenue multiples, and all these never-ending growth stories. Pets.com, Webvan, and a bunch of others really became the symbols of that period. The market hit its peak in March of 2000. By the time 2002 rolled around, the Nasdaq had plunged almost 78%. A lot of really smart folks ended up losing a significant amount of money back then. They made a pretty simple mistake. They mixed up a truly powerful technology with a surefire way to get rich quick. Now, AI is different in one way. It really is a genuinely powerful technology, with this huge long-term potential. You can't really argue with that part. But even so, this current frenzy still feels an awful lot like late-cycle euphoria. Companies are just pouring billions into infrastructure, placing big bets on seeing explosive returns. The thing is, those returns haven't quite appeared at scale just yet. When index growth relies so heavily on just a handful of players, that's usually a pretty clear signal. This doesn't really look like a broad, sustainable economic expansion, does it? It seems more like a high-risk gamble on a small cluster of companies, in a kind of winner-takes-most situation. And as always seems to happen, markets tend to correct quite sharply when expectations get too far ahead of what's actually real. If you're already invested, that's totally fine, enjoy the upside. Just make sure you're keeping your position sizes sensible, and always have an exit plan ready. Chasing this hype right now, that might not be the smartest play. Diversification isn't boring, you know. It's discipline. If you're still sitting on the sidelines, it probably makes more sense to just wait for a real correction, or at least for a situation with a better risk-reward balance. Trees don't grow to the sky, even the AI-powered ones. Machines are definitely learning, I'll give you that. But human greed, our short memories, and that old habit of turning groundbreaking technologies into speculative manias, Those things haven't disappeared at all. Now let's talk about the oil market. Let's just be straight about this. Why crude oil blew past $103 and closed at $103.92, up almost 2% in a single day. The reason is obvious. Things in the Strait of Hormuz are getting seriously tense. US-Iran tensions have basically frozen traffic through the choke point that moves about 1/5 of all the world's oil. What the screaming headlines won't tell you is how ridiculously fragile this whole global oil setup really is. Iranian strikes on UAE facilities and commercial ships have made everything worse. And now Goldman Sachs comes out saying global reserves could shrink to just 98 days of demand by the end of May. This isn't theory anymore. This is a real supply shock brewing. We've seen this story play out before. 1973, Arab embargo. Prices go crazy. Recession follows. 1990 to 91, Gulf War. Another nasty spike. Every time this narrow strait gets messy, the entire world economy gets slapped with the same reminder. We're still way too dependent on one tiny piece of water in a volatile region. Short-term traders are loving it, sure, but this kind of geopolitics-driven jump creates real pain down the line. Higher oil prices feed straight into inflation, jack up everything from shipping to manufacturing, and hit regular people right in the wallet. Especially when prices were already sticky as hell. This isn't some healthy bull market in oil. It's just a fat risk premium getting priced in because of military and political chaos. Markets hate this kind of uncertainty, and right now there's plenty of it to go around. Bottom line, if you're heavy in energy stocks, you might make some money in the short run. But don't get cocky. Things can reverse fast if tensions ease even a little. For everyone else, this is just more bad news on the inflation front at the worst possible time. Get ready for higher gas and energy bills, and governments are once again learning that energy security isn't some policy checkbox. It's survival stuff. Now let's talk about crypto. So Bitcoin's been on a pretty insane run lately. It's hovering near yearly highs again and even pushed above $82,000 for a moment this week. Over the last month alone, it's up around 17%. And of course, the headlines are back to full crypto euphoria, friendlier politics, stablecoin legislation moving through the Senate, all the usual excitement. But honestly, if you zoom out for a second, this rally still feels driven more by emotion and speculation than by some deep fundamental shift. That's the part people avoid talking about. Because underneath all the hype, this recovery still looks fragile. Sure, clearer rules around stablecoins are genuinely positive, and Washington becoming more crypto-friendly definitely matters. But Bitcoin is still extremely dependent on liquidity, investor risk appetite, and the broader economy. That hasn't changed. We've seen this before. Back in 2021, there was endless stimulus, cheap money everywhere, and non-stop hype pushing prices higher. Then 2022 arrived. Liquidity dried up, sentiment collapsed, and the entire sector got crushed. Fast. And honestly, that's just how crypto works. These violent cycles are part of the game. Big rallies built on optimism usually end the same way. Liquidity disappears, panic kicks in, and prices fall much faster than people expect. Now look, the technology behind Bitcoin really is impressive, and the digital gold narrative does have real logic behind it. But acting like every positive headline suddenly guarantees a permanent bull market. We've heard that story many times before. Right now, short-term momentum is clearly bullish. Hard to deny that. Still, valuations are getting stretched again. Bitcoin already seems to be pricing in almost a perfect scenario. Friendly regulation, major institutional inflows, and continued easy monetary policy. That's a lot. And if even one of those expectations fails, this thing can reverse very quickly. If you already own Bitcoin, fine. Enjoy the momentum. Just stay disciplined with risk management. This market can humble people unbelievably fast, and chasing highs with leverage right now probably not the smartest move. If you're still on the sidelines, patience makes more sense here. Waiting for a cleaner setup with better risk-reward is rarely a bad decision in crypto, because this market still runs heavily on narratives, and narratives can flip overnight. That's everything I wanted to talk about in today's video. If there's a topic you'd like me to cover next, leave a comment below and let me know. Thanks for watching all the way to the end. Make sure to subscribe to the channel, leave a like, and turn on notifications so you don't miss future videos.